Happy New Year. Welcome to the Ellsworth Advisors monthly update. I'm Kelly Keenan. This is Cameron Mealy. Today we will review what happened last month and through the course of last year, and also discuss kind of what we expect to happen this year. Cameron, why don't you kick us off with a little economic update?
Thank you, Kelly, and Happy New Year, everybody. Obviously, we're going to focus on what we see coming ahead in 2023, but did just want to hit on the third quarter and fourth quarter of 2022, talk about the GDP numbers. On December 22nd, the Bureau of Economic Analysis released their third estimate, which is really their final estimate for third quarter GDP. That number came in at 3.2% annualized growth. That's a revision from 2.9%. That was their second estimate. So very strong GDP number. Historically, we always look at U.S. GDP at around a 2% annual increase. So 3.2%, obviously a very strong number. Let's turn to the fourth quarter. This is the Atlanta Fed's GDP Now model. They're predicting an annualized increase in the fourth quarter of 3.7%. So very strong number there. If you look, we had two negative quarters in the first and second quarter, two very strong quarters in the third and fourth quarter. So that means GDP should end up around the 1.5% to 2% range, which is kind of normal for the U.S. economy. So with that ahead, we've got what looks like a lot of momentum in the third and fourth quarter, but that's not what the expectation is. So let's look real quickly at the expectations. This is from the Conference Board, their outlook for 2023. So I'm going to read this verbatim from one of their U.S. outlook for 2023. The economic outlook for the United States for 2023 has deteriorated under the weight of high inflation rates and rapid monetary tightening, falling consumer and business confidence, softening consumption and investment, and geopolitics, including energy shocks, are likely to tip the economy into recession around the turn of the year. However, the recession is projected to be short and mild amid a strong labor market and relatively healthy consumer and business balance sheets. So that's from the Conference Board. That's their expectations that we will dip into a mild recession in 2023. I'm going to give some of my thoughts on what I'm watching for 2023.
Okay, Cam.
And I will give you my thoughts, and then you can correct me, Kelly.
I do not correct. I just add a different perspective sometimes.
So, key themes for 2023. I agree with the Conference Board. I mean, if you read most Wall Street pundits and journalists do believe that we will be in a recession in 2023. They all do agree that it should be a mild one, more kind of just a shakeout than, a long down and dirty recession.
I concur.
Thank you, Kelly. So Kelly and I are on agreement once. Interest rates. Obviously, the Fed has been extremely aggressive trying to fight inflation, over 300 basis points of increases in 2022. The first Fed meeting is January 31st February 1st. The next meeting is March 21st to March 22nd. Now, again, if you listen to most pundits, there is an expectation that the Fed will probably raise rates 50 basis points in January and 50 basis points in March, and then maybe take a pause. We are starting to see inflation come down. We are starting to see business investment activity slowing down. It does seem like the Fed's intended goal with these aggressive interest rate increases is starting to take effect. So, the prediction right now, 50 basis points in January, 50 basis points in March. That gets you to a little over 5 to 5.5% as the Fed funds target rate. That seems to be where things are going.
And that's, I agree there. Terminal rate somewhere between 5 and 6% is where they'll probably shake out, is the thought process. There are some on Wall Street that think at some point later in the year they'll turn around and start reducing rates. I'm really not part of that camp. I think the Fed's going to keep rates higher just to, one, make sure the economy does slow down. We soak up a lot of the excesses to definitely tame inflation. That's the big wild card out there. A recession will help to slow things down, should stem inflation to some extent, but my expectation is we're going to be in a regime of higher inflation for a while, and not that 6, 7, 8% level, but in that 3 to 4% range. I think we're going to be there for at least throughout this year, maybe well into next year, in the next couple of years, in that 3 range. And I think along with that is going to be a higher interest rate regime, especially on the longer end.
And that's healthy. I think this Fed, I think we've all seen, anybody who works in the financial industry has seen that, the zero interest rate policy led to too many excesses. It led to extraordinarily cheap capital, a lot of speculation, a lot of this, super valuation of tech stocks. And I think the Fed has learned that despite a stumbling economy, there's got to be a bare minimum, cost of capital, rate.
Yeah, the only way to make money was to be speculative, be in stocks. It was the only way to get rates of return. We're going to move to an environment where you can get a return of money by not having to be heavy in stocks or heavy in speculative stocks. And that's kind of fallen into the theme of what we've been doing.
Yep. Number 3, inflation. Obviously, we saw inflation peak over a 40-year high last year. Expectation is that inflation is going to continue to moderate. A lot of pundits are thinking it can be down to the 5% range by the end of the year, and then hopefully in 2024 getting back to that 2 to 3% kind of normalized rate. But I think definitely we're seeing that this aggressive action by the Fed is taking capital out of the market. It's making the cost of borrowing for business and consumers much more expensive, and that really is moderating a lot of this pricing pressure. Also seeing supply chains kind of return back to normal.
I don't disagree with that. And I'm surprised they're only saying 5% by the end of the year. So that's good. That's in line with what our thoughts are.
Okay. Number 4 theme that we're watching: China coming out of its zero COVID policy. This could end up being, the Chinese economy has been, standstill is not the right word, but based on the 8-9% year-over-year growth we've seen out of China, these years during COVID with President Xi Jinping's zero COVID policy, a lot of manufacturing facilities shut down, a lot of people, forced at gunpoint to stay home, has definitely hurt the Chinese economy. And with an opening up of the Chinese economy, we kind of saw it with the U.S. There was kind of a big rush of spending and activity. China with 1.5 billion individuals, the manufacturing hub of the world, with their starting to come out of their zero COVID policy, should be a boost to global growth.
I think it's going to help some of our multinational companies, whether it's Apple or Nike, because of a little bit more consumer spending. There's different thoughts around around oil prices, and I've seen studies that even with them coming out, that's probably not going to put a lot of pressure on oil to the upside. I think we're still going to see elevated oil prices, but it's not going to be because of China. Just them coming out isn't going to change much of their use, or at least not substantially. China's got a lot of issues, and the fact that they have been shut down, I think that's put them behind an 8 ball when you're going to have the rest of the world still kind of contracting. So I see a lot of challenges in China, even though they have to come out, or they're going to set themselves back even further. But they still have to fight the pandemic now.
They do. All right, number 5 theme: weakening U.S. dollar. We've seen a strong run up in the U.S. dollar during 2022. The U.S. dollar obviously is the reserve currency of the world. Many financial assets are denominated in U.S. dollars. Strong U.S. dollar does hurt U.S. companies exporting to foreign countries. It makes our products more expensive. So if we do see a weakening dollar, which is the expectation again by many pundits on Wall Street, that should help U.S. businesses export more internationally.
Yeah, and I mean, the dollar's it has been so strong. Weakening, I think, will not necessarily be a bad thing. It's not falling off the map. It's not going to be replaced or anything. You would think it should happen. The catch-22 there is if we go into recession, that tends to strengthen the dollar. So we'll see. We're not making any macro bets on the dollar, and nothing we're doing really hinges on a stronger or weaker dollar. It just kind of is. That's not a pool I want to swim in because it's so unpredictable. All
right, 2 more themes I'm watching. Number 6, rotation of funds back into tech stocks. Now, this is more of a second half year phenomenon. Get through the recession, people starting to reallocate capital. I mean, if you think about it, artificial intelligence, cloud-based storage, automation, autonomous vehicles, they permeate every sector of the economy. Tight labor market, automation is key. Cloud-based storage, physical storage is no longer the secure method of storing data. I mean, technology is so embedded in our society. I do think when we see the U.S. coming out of a recession, when we see capital being redeployed to the equity markets, we are going to see, again, strong. Maybe we don't get back to the valuations we had 16, 18 months ago, but I do think technology is so beaten down, you're going to see money kind of flooding into those investments.
I'll disagree there a little bit.
We can disagree. We can still disagree.
We very well could have a major, there's still a shoe to drop in the big tech, mega cap tech. We're still going to see downside there, at least through the, like you said, the first part of the year. Even once they do hit their lows, I am not expecting them to be the leaders in the next couple of years. I think they have a long way to go. You're going to have different leadership coming out, into the next cycle, and it won't be the mega cap stocks or the mega cap tech stocks for leadership the next several years. That's how it works. I mean, we've seen that whether it was 2000, 2001, going back into the 70s, 80s with the blue chips or the Nifty 50 stocks. They were not the leaders coming out, and even in 08, 09, that's really when tech took back over, because between 2002 and 09, they were laggards. They were no place to be found. And this is kind of the same type of situation. So, I mean, we have stuff we're holding because long-term they're good holds. Apple's good long-term quality stock, NVIDIA. But in general, we're definitely not loading up on them. And, will we start nibbling the second half of the year? Probably a little bit here and there. Once again, it comes down to valuations and
valuation is
kind of
key.
how things are happening.
And, my one counter,
how things are playing out.
My one counter to that is we did see in 2000, 2001, that was more the dot-com bubble. So a lot of those businesses had no business even being companies, had no businesses in the valuations. I think today when you look at companies like your Apple, like your Microsoft, like your Amazon, world-leading companies, valuations got ahead of them, but they have real purpose here.
I don't disagree, but Cisco still hasn't seen the same highs, nor has Intel prior to the dot-com bust, and they are high-quality companies that continue.
All of a sudden, we become the Hannity and Combs of the financial world.
Different perspectives.
Yeah. Okay, number 7.
Yeah, then we got to jump into the numbers.
Then we got to jump into the numbers. Credit markets. So according to Bloomberg, there's about $650 billion of bonds and loans in distressed territory. Again, this is fallout from easy money. And we're starting to see those credit markets, we're starting to see company balance sheets not look as attractive because all this variable debt has gotten much more expensive.
Yep.
Consumer spending and sentiment is drying up a little bit. Business investment is drying up a little bit. So we've got a real globally distressed debt issue.
Yeah, this is the crack that not a lot of people are talking about. Mm-hmm. And as we get into recession, I think this is where the breakage is going to be. And when we start to see that breakage, that probably signals the next big leg down and the final big leg down in the market. I think that's going to be the signal. For the most part, we've stayed away from that. So I don't think, our clients are not exposed to any kind of significance. I mean, we have minimal exposure to that arena, and we're going to stay away from that. I mean, right now it's, high quality, treasuries, T-bills, munis. That's where we're going to, hang out in bonds for the time being until we get, kind of through the recession or into the recession. But credit, that's where the biggest risk is right now, and you're going to see some damage there at some point.
And frankly, a lot of that is global, and it's tied to the real estate markets.
Correct.
So the U.S. does seem to be fairly well insulated against this credit crisis, but still, a credit crisis globally is going to create hardship in the U.S.
Right, and just in general, you'll see, collateral damage in the short term, where if those markets get stressed, it'll bring the other markets down temporarily because people are going to be, looking for liquidity, looking for assets, and they're going to have to go to, basically the equity market to raise capital, or the high quality bond market. From a performance standpoint, in December, we had a great November. Well, actually, fourth quarter was a good quarter, but we definitely gave, the markets in general gave back in December. Dow Jones was down 3.73%, S&P 500 was down 5.7%, NASDAQ down 8.7%, Russell 2000, which is small caps, that was down 7%, the MSCI, which is developed world, down 1.4%, the MSCI emerging markets down 1.8%. That was for December. For the year, the Dow ended down 8.8%, the S&P ended down 19.4%, NASDAQ ended down 33%, Russell 2000 down 21.6%, internationally the EAFE down 16.3%, and emerging markets down 22.4%. So, the Dow was the place to be last year. Once again, kind of your solid companies, good balance sheets, dividend payers. I think that's going to continue to be the theme for a while, that's for sure. Our portfolios, dividend yield, kind of in line with the Dow, down 3.7%. last month. Year to date down 7.45, so good solid year performance out of dividend yield. In December, Southern Company up 5.6, Pfizer up 3%. In December, our laggards, Blackstone down 19%, still feeling pain. Intel down 12%, UPS down 7.6. For the year, Merck was our big winner, up 49% for the year. Caterpillar up 18.5% for the year. Con Ed up 15.6% for the year. So some nice winners there. Once again, the year-to-date or the laggards for 22, Intel down 46%, Blackstone down 39%, 3M down 29%. Blackstone, I will note, we made a lot of money in Blackstone. We probably took more than that off the table early last year. So we've captured a lot of gains in there. We'll see what happens this year. Growth with income for December down 3.1. For the year down 8.5. So once again, kind of in line with the Dow, but we're only about 50% in stocks in there. Gainers in December, Nike up 7%. I think part of that was the China story. That it's a big group of buyers coming back there. Our gold position up 3%, and Lennar, the home builder, up 3% in December. Laggards, Nvidia gave up about 14%. Apple gave up 12%. Nucor gave up 11%. Microchip Technology down 11%. For the year, the big gainers, Exxon up 56%. Nucor, even though we gave up 11 in December, still up 17.2 for the year. Our PIMCO, our commodity fund, up 9% for the year, and J&J up 6% for the year. Once again, the big laggards, Nvidia, once again, kind of same story as Blackstone. We took a bunch off the table there early last year, but still down 50%. Disney still feeling pain, down 44%. Digital Realty down 41%. Nike, same thing, down 7 or up 7 in December, but still down 29% for the year. So obviously, we're keeping a close eye on those. We may be making some changes with some of those holdings. Our price potential portfolio down 3.5% for the month. Year to date down 12.5%. So much better than the Nasdaq, much better than the S&P. But definitely lagged the Dow, which I would expect because it is definitely a little bit more aggressive. Big gainers in December, Stryker up 5%, Abbott Labs up 2%, Boston Scientific up 2.2%. Actually, Facebook, we picked up about 2% there. Our laggards, Google down 12.5%, CarMax down 12.2%, FleetCor Technologies down 6.4%. Big winners for the year that we're still holding on to, Asbury Automotive up 12%, Humana up 11%, Boston Scientific up 8.5%, a little theme there with healthcare.
Yeah.
And then our laggards, Facebook, big pain there, down 64%. CarMax down 43%, so you have two different auto dealers, CarMax down 43%, Asbury up 12%. I guess that comes down to management. Google down 39%, Microsoft down 28%. Our small cap portfolio, December down 8.5%. Obviously it was a volatile month. Small caps got hit harder. Overall, though, for the year down 17%. Compared to the Nasdaq down 33% and the Russell down 21.6%. Pretty happy with the way small caps performed. Big gainers, White Mountain Insurance up 4%. Consolidated Water up 2.2%. Laggards, Clearfield down 28%. Greene County Bank down 24.7%. Lantheus down 18%, and Universal Logistics down 11%. Big gainers though, Lantheus, I just mentioned, we gave up 18% in December, but for the year we're still up 98% in there. Greene County Bank, once again, we gave up 24% in December, but it's still up 24% for the year. Excel Service up 17%. Clearfield, same thing. We gave up 28% in December, but still up 11.5% for the year. Right now in the portfolio, we're out of anything that was down, we're out of at the end of the year for the small cap portfolio. So that's kind of where we're at. Expectation-wise, I think we have it's going to be a volatile first half.
We're going to be cautious.
We have to be cautious, make sure we have plenty of dry powder, sticking with the T-bills for now. Munis were appropriate, staying short term on our bonds, but we are picking up nice. I mean, we're picking up 4.5% in those bonds, so we'll take that out of T-bills for now, and just kind of hang on, be conscious of what we're doing for the next 6 months, and I think where we start to advance is going to be second half of the year.
So if you have any questions, please feel free to give us a call. As always, we appreciate your trust. Happy New Year. Talk to you again in February.
Happy New Year.